Welcome here, everybody, for workshop number 3, proper protection, and really building a financial foundation. The 2 previous workshops, as a reminder, we had one on how to keep some of your money in basic concepts, and then how to get out of debt and control your income, where everybody has an income and everybody has expenses, and everybody can control their expenses and their income, and they got to keep them one above the other. Now, you could do the other way and have your income below your expenses for a while, but eventually it will lead to poverty. And you may feel richer, but you got to make sure your expenses are under control. And so let me share a screen here. Preparing with proper protection. And if my audio cuts out, just jump in and say, hey, something's not working, or I can't hear you. But as a disclaimer, we do everything we can to make sure all of our information is up to date, current, and this is not an offer to give advice. You're not going to buy a policy at the end of this. We don't email you a policy, but we want you to know how to ask the right questions, both when you're buying, and we want you to ask the right questions when you're marketing and then offering. But as a goal, our company is really, give me 1 second. We are running a 30 by 30 financial literacy workshop, financial literacy campaign, which really means we want to educate 30 million people by 2030. And we want people to be a part of a campaign. It's really changing the financial industry. I think it changes in 2 major ways. We go after the middle income market. A lot of our competition is moving out of that market, as well as we don't have an ivory tower. We don't have a huge barrier of entry. You can come in here, just go through the provincial cost of getting licensed and be in business for yourself. And so we're expanding. Our workshops, I think, are very, very unique, that every day we're flooded with information, and people offer financial advice everywhere, but most of them are unlicensed, but majorly without industry experience. And all of our instructors have industry experience. And those in the old traditional industry usually have a narrow focus. They say, I want to do investments, I want to do insurance, I want to do, and basically they're taught you'll be more profitable if you're more narrowly focused, which is true, but you end up leaving the masses behind. And so we want to do a holistic approach. We think you can be a generalist and still build a great business through scaling and through training people. But here's what we're going to learn today. We're going to go through what we call the X-curve concept, and to make sure the concept makes sense. Then we're going to talk about why proper protection is the foundation. Hey, welcome here, Sarah. Then we're going to talk about the value of properly protecting your assets and your liabilities, and how this benefits your overall strategy. And then some most common questions and some mistakes. But one of the things we believe in World System Builder isn't to do financial planning for people, but to give them a structure where they can do their own financial planning. And this is the structure. So we think, hey, like building a house, you build it from the ground up. And so we talk about the proper protection, and it depends on what your situation is, that's what you have to cover. So if someone's relying on your income, if someone's relying on if you got sick, making sure that anytime there's an unforeseeable emergency, that can be covered by you. Then get yourself in control of debt, lots of cash, and get some understanding on investing. And like building a house, you build it from the ground up. And so everybody can kind of look at their own situation and say, how much insurance do I have and what do I pay for it? How much debt do I have? What do I pay for it? How much cash do I have? How much am I adding? And what are my investments worth? And am I adding to that? And that's really 8 numbers, how much you have and how much you're paying for it. That kind of your current situation on your financial plan. The X-curve concept is basically the motion of the protection and the investments funded by your cash flow. So whether you have debt or emergency cash. And so it theorizes that in general, a person's responsibility decreases over time and their wealth increases over time. What I mean by that is, as I get older, my kids grow up and they move out. Now, if I start a second family and I got more responsibility, the more kids I have, it starts going up. But as I get older in life, the responsibility I have to take care of others should lessen. And it provides a clear approach for building your financial foundation. That usually when I'm young, very little savings, high responsibility. But when I'm older, I've paid off my house, hopefully. Kids went to school, kids got jobs, moved out of the house. I paid off my credit cards, I saved some money, and I don't have the responsibility to do that anymore. But the other side is, I usually don't have any much saved when I'm young. So starting to build wealth, I must accumulate wealth to retire. And so more wealth and less responsibility when I'm older. So when I put this together, we can look at when you're young, you need to buy some insurance to protect if I passed away or got sick. But when I'm old, I need money. And so insurance is a way of renting money to say, hey, I'll pay a fee for someone to have money in case there's a crisis. And so generally you're less secure when you're young, but you become more secure when you're old. Now, this is only true if you pay off your responsibility and save money. A lot of people don't end up paying off their responsibility and they don't end up saving money. And so the main question on the bottom curve is, do you save money every month? And are you covering your responsibility? But when we look at this, we ask questions like in the book. If you have a textbook, I'm not sure who all has a book, some come, some don't. But we ask the question of, according to the X curve, you should wait until you pay off all your responsibilities before building wealth. False. Sometimes you might go your whole life and you might figure out your insurance, figure out your investment, but never really figure out cash flow. So you might be in a position where you say, I always have a little bit of debt, never any cash. You should invest anyways. And each layer is on its own. According to responsibility curve, you have more responsibility when you're older. False. You have more need for money because you're working less. And generally when you're young, we may have enough wealth to take care of our responsibilities. Generally, we don't have enough money when we're young. We only have money after decades and decades of compounding. And so what are the most common things you insure? So insurance fundamentally is, there's a company that has a huge reserve of money. And they say you can access our reserve if you pay us a fee. That fee depends on what the criteria is of claiming. So if you insure your car, your heart, your phone, your wedding ring, your house, your vacation, your pet, and depending on what you insure, it depends on the price you pay for that insurance. And so the more expensive insurance is, you should think, okay, that means there's a higher probability that I would claim. So if I insure my phone and they say, hey, it's $5 for you to insure your phone, what happens is I don't have it's not a high risk of damage. It's only $5. But if they say, hey, you got to insure your life, it's $200 or $500. Now you got to think, okay, well, in that case, it must be more likely to happen. And so insurance is a means of protection from financial loss. And so when we look at ourselves, our ability to produce income is something that's very valuable. And if I died, I would lose that. And so in exchange for premium payments, the insurance company provides a lump sum to my survival, who would depend on my income. And it's a very fundamental way of protecting. And it really came out a couple hundred years ago where people said, hey, our family's passing away and it's a major problem. Why don't we get a bunch of people in the community to pool some money together? Then when someone dies, we could fund them. And that money that those people put a pool together was able to grow for the last couple hundred years. And most insurance companies are hundreds of years old. And so it's a matter of perspective. Here's a quick letter. It says, hi, I am your insurance policy. You and I have similar purposes in this world. It is your job to provide food, clothing, shelter, school, medicine, and other things for the ones you love. You do this while I'm in a safe place. I have faith and trust in you. Out of your earnings will come the cost of my upkeep. At times I may appear insignificant to you, but someday, and who knows when, you and I will change places. When you are laid to rest, I come alive and do your job. I may provide food, clothing, shelter, schooling, medicine, and other things your family will continue to need, just as you are providing now. When your work and labor are done, mine will begin. Through me, your hands can carry on. Whether you feel your price for my upkeep is burdensome, remember, I can do more for you and your family than you ever do for me. Knowing how a policy like me works will help you understand my role in your overall financial foundation. Together, we can help protect the future of your family. If you do your part, I will do mine. And it's a matter of perspective, where someone said, an adult doesn't really have the ability to be unselfish until they have children. Because until they have children, they are the most important. And then they have kids and they become, hey, maybe there's some other important. And so sometimes people say, I give to charity, I want to divide my money between my kids, or business planning, or I want to create wealth. I want to create an inheritance more than I could just do by saving money. And so, like anything not frequently talked about, most people don't talk about insurance. They ask, hey, what type is for you? What do I get? Who benefits from my payment? You know, does this make sense? Is this good for me, or is it bad for me? Is it good for the salesman, bad for the client? And the options, you can build unlimited ways to build an insurance. And in fact, the name of the insurance, whether it's term insurance, universal life insurance, or whole life insurance, is almost irrelevant, but the structure behind the name is what's relevant. And so we're going to look at some basics. How premium is determined. I think it's fair. Fair is not really a business term, because business is not always fair, but we say, hey, the cost of insurance is determined but not limited to these criteria. So let's say 100 of us get into a room and we want to decide who pays more, who pays less. Old people pay more. Heavier people pay more. If you have health issues, you pay more too. If you're on lots of medication, you pay more. If you smoke, double or triple that guy's payment. If you got a family health history and your parents have a bunch of health issues, that guy could pay more. If you don't know how to drive and you get a bunch of speeding tickets or accidents, pay more. And if you scuba dive, auto race, you're flying an airplane, all these kind of things, we want you to pay more. So what pays less? Younger, healthier, no health issues, you're not on medication, you don't smoke, your parents are healthy, you don't have a big long list of driving record, you don't do any dangerous activities. So everybody's price is different. And some things that are not factored into premium, if you're in the textbook, you can circle hair color. Doesn't matter. If it's gray or black or whatever, it does not matter. They don't take a picture of you. Or when you look at what's not factored in, religion. Doesn't make a difference. One of the things that we look at is not eye color, not riding a bicycle. But we do look at someone's weight. We do look at their medication, family history, tobacco use. They want to make sure people get priced properly and priced fairly. And so usually there's two situations. You either can get life insurance or you can't. And if you could get it, is it the right price, or do you pay what we call a rating? So how much life insurance someone buys is probably the most important question. The second question is, what's the type of insurance? Third question is, what's the cost? Because it's got to be in the budget, it's got to be comfortable. The dime method is an easy way to figure out. So you buy life insurance to have enough coverage for a potential loss. No one would buy 100,000 coverage on a $500,000 house. So if you want to figure out, hey, how much life insurance do you pay for? How much debt have you not paid back? Your income times a minimum of 10 years. If I passed away, how many years is it going to take my wife to replace me? Maybe 20, maybe 30 years, maybe never replace. Maybe I need a lifetime of income. Mortgage. Do I want my mortgage paid off? And my kids' education, or a gift to my kids, we call it estate. Dime, it could be estate or education. But these are the things that cost money when people pass away. And so if someone has 50,000 in debt, then maybe they make 50,000 a year. So they need 500,000. Maybe mortgage is 300,000. So they're at 850. Kids' education is 50 for two kids, 950,000. It's very common to do a $900, $2 million policy on a regular basis. And so when we look at the different insurance, we want to know, hey, what is the type And how does this work? So there's two main types of insurance. There's term insurance. The cost of insurance goes up as you age. And there's permanent. In fact, the cost of insurance goes up as you age. The question is, how and when do you pay for it? And who takes the risk? So these are the two questions. How and when do you pay? Who takes the risk? So the main difference between term and permanent is something called cash value. So if you overpay, sometimes they give you cash value. So let's look at this. A term insurance, very simple. Only two ways you can use a term insurance. You can claim on it, or you can convert it or upgrade. But if you're going to pay for it, you can pay annual renewable term, which means every year, depending on your age, that's the price. So if I'm 39, that's the price. 30, 40, that's the price. 41, and it goes up slightly every year, except when I'm in my 70s, 75, it goes up a lot. 80, 76, it jumps a lot. And so the rate of increase increases as you age too. 5-year term usually matches a mortgage. 10-year term, 20-year term is the most common. I cover my kids, then the price jumps up and maybe I cancel. So term insurance usually terminates. The insurance company doesn't terminate it usually till you're 85, but you terminate it because the price becomes ridiculous. So group term, usually it's small. You don't need to qualify, it's inexpensive, but the employer can change the plan at any time. So the question of who takes the risk, you take the risk of the employer making a change, or if you leave the employment. It says, watch out, insurance provided by your employer may terminate when you leave the employment. Nothing wrong with that. You just left the employment, right? And accidental death is inexpensive, but if you could qualify for a real plan, that's a better one. So here's an example. This is a 30-year-old female, standard rate class, non-smoker. They pay $400 a month for 20 years. Then it switches from a 20-year term to a 1-year term. So you can see at age 50, let me get a pen here. You can see at age 50, it goes up to $2,000. And in your textbook, you actually get an example of this. You can write it down in your notes. The cost is $400 year one, but the cost is $2,000 a year 21. And then it slowly goes up every year. This works really well if you intend on terminating the policy. So if you say, I got a 2-year-old kid, I need coverage for 20 years, $400 a year seems very reasonable for $500,000 of risk. So the insurance company puts $500,000 aside for you. They collect $400 a year. So they collect 0.1%. So they're not getting rich off this. They collect 0.1%, and then you have the choice if you want to cancel it later on. If you keep it, then what happens is $400, you pay $8,000 first 20 years. And let me clear my drawings. After the next 20 years, you pay a total of $2,000. It's $2,000 plus $90,000. So the first 20 years, it's $8,000. The next 20 years, it's $90,000. So here's a popular theory out there. Now, you have to know the different concepts and which concept applies to you or your client. They say buy term and invest the difference. And in 20 years, you'll be so rich, you don't need term insurance. And so what happens is you pay $400 a year, expecting that in 20 years you'll be rich. And then that 20 years later, it costs you $90,000, but you say, I'll just cancel it. So the reality is this: when I go into the marketplace and I talk to 50-year-olds, most 50-year-olds still need insurance. So they don't need zero. Maybe they buy half the amount and pay half the less. But are you going to be totally financially independent at age 50? And so then maybe have to buy a longer term. But I don't think your insurance need drops from $500,000 to zero overnight. So most times when we do term, we actually do a term combo where we do 20-year term, 30-year term, 40-year term, different terms. So maybe at $250,000, you do 100,000 of each different term. So as you get older, it slowly drops. It saves a little bit of money. But hey, the biggest advantage of term, low cost. It covers a liability for a specific amount of time. The disadvantage, it's only insurable a specific amount of time. Now, it depends if that's what you're looking for. If you just want to protect your kids while you're young, term is wonderful. Premium is wasted if you don't pass away, so you take the risk of outliving the term. There's many risks, and one of them is if you live too long, it doesn't pay out. And if you become uninsurable, you have to keep it to renew. And a policy cannot be renewed beyond the maximum age. So the renewal of a term is a huge jump, but in a YRT, it slowly climbs up. So it's a little different. So because term insurance is for a set period of time, you may live longer than that set period of term. So the case for permanent is this. If we have a term insurance and it runs out, we have no insurance when we're old. Now, most people die when they're old. So the question is, do we need insurance when we're old? So we have something called what I refer to as the widow's gap. And what the widow
downstairs? Tamara, who's down?
What the widow's gap is if I pass away at age 80, it's likely my wife will outlive me by 5 years. Now, will my government pension transfer to her? Depends on her income, depends on her CPP, OAS, GIS situation. But she'll probably lose $1,000 to $2,000 a month for an average of 5 years. So it's about $60,000 in government pension a spouse loses when they pass away. Then what happens is maybe my wife wants a down payment for a new house because she doesn't want to live in the house I died in. That's maybe another $50,000. Then also what happens is my income and my estate might not transfer to her for 90 days to a year, depending how it's built. And so I might need 90 days to 1 year income. So typically people need, plus a funeral, 6 months income to 5 years of income. That's the permanent need for my widow to be okay. Hey, after 5 years, if she could take over my retirement. Another need for permanent insurance is to protect the retirement, where if I only have my investments, so let's say I save $1 million to retire and I have no life insurance. I have to spend my money to zero. Then my family gets nothing. But if I have only $800,000 in retirement savings and maybe $400,000 or $500,000 in insurance, and I got sick, and I tell my wife, hey, I'd like to spend my money now. I'd like to travel. And she says, we can't. I said, don't worry. We're going to spend $300,000 or $400,000, and then it'll replace it with my insurance policy. And now I can use it to replace my value that I'm going to use up my last 2 years if I have a terminal illness. So let's look at how this is priced. And by the way, I think a lot of insurance policies, regardless how you build it, looks like this. Let me clear my drawing. Yeah, it looks like this. We say, how long will you live? Think about the debt, loans, mortgages. A lot of people go into retirement with a mortgage. But if term insurance is like renting an apartment, permanent insurance is like owning a home. When you own a home, it's a lot of money up front, plus it's more money every month. But when you get old, you think, that made sense, I bought a home, right? Very few people think, oh, I should have rented. But when you look at the cost of insurance going up, the green is the payment. So if you pay more early on, you don't have to pay more later on. That's it. So you say, hey, that makes sense. I'll pay more early on, so I don't have to pay more later on. And that overpayment early covers the insurance costs later. That's it. And so there's two choices of permanent. One is a whole life insurance, and the other is a universal life insurance. Whole life means we take the risk. WL means we take the risk as the insurance company. Universal life means you take the risk as the individual. So the insurance company doesn't know what the price of the insurance should be. So they say, based on the market performance, we think it should be $300 a month. But if the market doesn't perform as much, you got to put a little extra. But if the market performs very well, you could stop paying a little earlier. You could pay a little less, so you can have some flexible premium. But universal life, you take the risk, and you get some flexibility that if you overpay early, you could pay, you get some adjustments. Whole life is we take the risk, the insurance company. So let's look at how it's priced. Whole life is a policy you keep your whole life. Part of your premium purchase insurance that can be sold back to the life insurance company, creating cash value. So you get a fixed premium. You can overfund a whole life policy. So if you want more cash value, put it in. They take the risk. So what happens is you get an incredible return, about 5 times what the bank gives you, without any market risk. And so that money, the insurance company says, hey, we're going to make money in our reserve most years, like the market. And so we'll pay you a consistent return always. We'll guarantee this will never lapse, regardless of the market performance. And it'll likely grow the death benefit. So some of the benefits are you get a fixed level premium for life, or most people, when they buy a policy, they do a paid up feature, which means you do 20 pay or 10 pay. Say, I'll pay till I'm this age and that's it. So paid up feature, very nice, very hard to replace. I just bumped into one the other day and they bought it when they're 20. They're now in their 40s. It's paid up. It was a 30 pay, paid up soon. I can't touch it because it's been so long, right? So you get a really high quality guaranteed rate on the cash value. And the cash value, you can get it through a withdrawal. I can't give you a recommendation, but a withdrawal, anything above the ACB, which is the adjusted cost basis. ACB is adjusted cost of what you put in. So anything above what you put in can trigger tax. Or you could surrender the policy. Anything above what you put in, the ACB is taxed. Or you can do a policy loan. If the policy loan is less than what you put in, it's tax-free. Or you can do a bank loan, which is also, it's totally tax-free. We call it a collateral loan. So you can access your money. Most times, in most investments, you can only cash it out. And the policy may receive dividends, the profit back. So what happens is you pay for the policy, the insurance company estimates the cost, they overestimate, so you overpay, then all that extra money says we're going to go and we're going to pay back to you. And so it's a very stable foundation that there's no long-term management, there's no long-term adjustments. You could even not do a review for 10 years if the client knows how it works because we're not adjusting anything. But let me show you what a policy looks like. This is a policy. They have a $500,000 premium. So you see that right here, $500,000 death benefit, sorry, $500 premium, called $6,000 a year. It's TFSA, it's like a TFSA deposit, $6,000 a year. This person is a 30-year-old female. Clear drawing. 1 second, I got to double click to get back to my, click the next slide. So we want to know, what do you pay? What do you get? So let's review this. The policy is guaranteed never to drop, never ever to drop. So every year you're going to get a statement that looks like this. In year 1, you're 500,000. Never drop. So it shows 500,000 the whole way through. Now you could put extra money in. This one doesn't show any extra money. It's just a pure whole life. You can add extra money. You can add term to it, critical illness, lots of things. You can see here someone pays a payment of $6,000 and their death benefit is $501,000 because the death benefit grows in the policy. Just think about buying a $500,000 house. In year 30, it's worth almost $1 million death benefit. And so I can look at what I pay. If someone pays $6,000 per year, their family gets $900,000 out. Now, I don't know a lot of people that put away $6,000 and have $1 million in their TFSA. But what happens is this cash value, in a whole life, the cash value is not your overfunding. The cash value is the present value of the future death benefit minus any unpaid premium. So in the beginning, it's all unpaid premium. You can just buy new policies. But what happens is, let's say in year 85, this is a life expectancy year, they're going to pay 1.8 million out. If you miss a payment, they would just take that payment from your cash value. So it's almost unlapsable. You're never going to make a mistake. Now, if you canceled it, they'd buy back for you 1.4 million. You could get a bank loan for 90% of that. And so it puts you in a position where you have a death benefit. This is like equity in the home. If you took that money out, let's say you took $1 million out, then just $843 gets paid to the family if you take out $1 million. And so very good in the future. I think the whole life insurance in many ways will replace the RRSP industry because you can access it if you die tax-free. And if you access it through an institution like a bank, it's also can be tax-free. And so when you look at this, what I pay and what I get out. Let's summarize this thing. Well, let me go back here. So if I'm putting in 60,000 a year over 10 years, 6,000 a year, over 20 years, I put in 120,000. My family, if I died, would get 700,000. It's very hard to turn 120 into 700. I could get my money back in 20 years. In 40 years, I put 240 in, and my death benefit is 1.2 million. So I'd earn $1 million in interest. I could access 700,000. So the way we evaluate life insurance is how much do I pay? How much do I get? When do I pay? When do I get? That's it. And then, of course, who takes the risk? So advantage, get a guaranteed interest rate. You don't have to monitor the markets. You have a schedule. You can choose 10, 20, 30 pay. And it's designed to last your entire life. You don't pay tax as it grows. Now, sometimes the guaranteed interest rate could be a conservative rate. I don't know if that's true in 2022. I like, right now a dividend rate is 6.2. I don't have any bank offering 6.2. And the premium is fixed. So let's look at universal life. Universal life came around to say, consumers said, we want more cash value early on, and we think the market's going to go up and up and up. So if the market goes up, we want it cheaper. So they said, well, the cost of insurance goes up anyways. Why don't we build it in two parts? Universal life is if term insurance is if you die, we pay. Universal life is two parts. If you die, we pay. If you don't die, we pay too, but we pay your cash value. So here's how it looks. You get a flexible premium. So you choose your premium. Now, if you pay too little, we can run an illustration. If you pay too little, your permanent becomes term. So you take a little bit of risk. If you don't put enough money early on to cover the future cost, it becomes term and it lapses and you don't get anything back. Or if the interest rate doesn't perform well, you also could lapse the policy. So the flexible premium with a minimum and a maximum, I recommend getting closer to the maximum. Say, hey, what's my maximum? And maybe you have to buy a smaller insurance to get closer to the maximum. So here's how it works. Some of the premium pays for the cost of insurance. So it's a pure, like a term. The rest of it get invested. So you have cost of insurance and investment. Very, very simple. And it allows flexibility where you get to choose your investment choices. And you can get cash value through a withdrawal policy loan. You can get 50% into a collateral loan. And or you can do a cancel, of course. If you cancel, there are surrender charges in a universal life, typically for the first 5 to 15 years, usually around 10. In a whole life, when you add extra money, there's no surrender charges. And with term, there's no cash. So of course, no surrender charges. The universal life, it's a hybrid. It's like whole life and it's like term. It's the best of both and the worst of both. Very low cost insurance upfront, so you build a bigger cash value. But more cost insurance later, so you're going to use your cash value to pay the cost. So around 60 to 70, your cash value starts to go the other way because you're paying for cost of insurance. If the cash value goes to zero, you either have to pay the cost of insurance out of pocket or lapse your policy. So let's look at it. Similar premium, we got a $500,000 coverage. Now we got to look at how to evaluate a universal life. The first year cost of insurance is $400, similar to term. In fact, same price as term. Now we're going to put in more than $400. We're going to put 500 a month. And so they say, oh, okay, this makes sense. So you put in more money than the term. And now we're going to look at this. Let's evaluate this thing. So same age as the whole life. We assume the primary rate of return is 6. Now it's either going to be above 6 or below 6, but we don't know. But 6 has been a long-term average in the past. So we can say, hey, this is a long-term average. Your planned premium, you could choose to adjust this based on the interest rate you're getting. If you're getting a great rate of return, you could pay a little less and it'll still work. Now, when we're evaluating it, we want to know the annual charges is right here. And you can see that that goes up over time. And so the 6,000 you're putting in, some goes to annual charges and some goes to fund value. That's how universal life works. And now your death benefit, a lot of people who don't understand how it works is you don't get both. You get both. You choose. So if your cash value is 5,609, then your death benefit is 500,000 plus 5,609. If your cash value here is 74,000, then over here, your death benefit is 500,000 and 74,000 and change. Maybe they rounded error somewhere different. And so you have your annual charges and your fund value. That's how insurance, that's how universal life insurance works. Sometimes the rate of return, if you have a negative period, you got to add a little more money in the negative period is best. Or if you notice it late, you can add it late. But universal life is market investment plus term insurance. As you get older, let me see if I can get a little older ages. Now we're building up more cash value. If you put in too much money into cash value and the return does well, it'll end up in a side balance account. That is taxable, but that means your program performed. If you have a cash value of $1 million and 29,000 is in a taxable account and you were in 6%, 6% of 29,000 is like 2,000. No. 6% of 29,000 is like $1,000, give or take. So the tax on that at 30% is like $300. So you may get a $300 tax bill, maybe. And so, but that's just a short temporary period of time. When you pass away, the main thing to know about a policy is if you have $1 million of fund value, 100,000 of fund value, 500,000 plus 132. And if you have 1.5 million of cash value here, you have 1.5 million of cash value plus the 500,000 insurance. And the annual charges, of course, goes up. You stop paying premium at age 70 and the interest rates takes over. So some of the problems of universal life, if someone says, let me go back. If someone says, let me delete my lines. My cost of insurance is only $386. I want to pay $600 a year. It's not permanent because eventually, when you in 20 years, it's 800, so you're going to lapse the policy. So it's meant to be overfunded, but it gives you the flexibility to take a year off and start again. So there's a flexibility to the money going in, but there's not a lot of flexibility to the money coming out because that money is intended to pay for future premium. But you take the investment risk, you choose that long-term investment rate to run your policy at, and we choose the investments to try to match what we illustrated. When we do a policy review, we look at what was the illustration we got last year and what did we get this year? And how much premium should we be putting in? Flexible death benefit as needs change. And the permanent policy is designed to last your entire life. You get access to cash value, tax advantage growth. It's not taxed unless you surrender it. And underfunded policies may require additional premiums later in life. That's one of the risks of, hey, I want the flexibility. So the insurance company says, well, if you get the flexibility, we get the flexibility too. to change the, you just pay like wholesale cost. And you get a guaranteed interest rate, tends to be conservative. So if you choose a guaranteed rate inside a UL, you don't get the advantage of the ability to put money in the market. So let's look at some comparisons. Term insurance has flexible premiums. You can skip payments without the policy lapsing. It's on page 33 of your book. False. Not flexible premium. Cheap premium. Future term insurance renewals are lower. False. Renewals rate higher. Group term insurance from your employer may terminate if you leave your employment. True. Now, there's nothing wrong with that. There's something wrong if you get surprised by that. In universal life, final expense is a type of a term. Final expense for a funeral should be permanent. Universal life has a flexible premium. False. So here, term, whole life, and universal life. Term insurance, you just pay the cost of insurance leveled over a 10, 20, 30 year period. Whole life, it's a lifetime of insurance. The death benefit grows over time with what's called paid up additions. In universal life, you choose your premium. Usually you should match the whole life premium and let the cash build up. And your future survivability of the policy is based on how much you put in and the market performance. So you can add policies to this. The most common way to build a policy looks like this. You say, I want to have a base policy, permanent, term, or whole life. Whole life or universal life. In the marketplace, most whole lives I see aren't overfunded, so there's very little cash value. And most universal lives I see also aren't overfunded, so they're not going to last as long as they should. But when people know, oh, I get it. Hey, I always want to buy a small permanent, usually starting off. I don't want to buy a big term because I have a young family. Now, if you don't have a young family, your situation is different. If you just want to cover a funeral or give a gift, most policies have a term component and a permanent component. But I also have a critical illness component if I got sick. So the way we look at that is this. The way I explain it, I say, listen, there's 4 parts to an insurance policy. This is what I personally do. 4 parts. I say there's a permanent part. You should buy the one you understand. There's a term part, like I just showed you. So we call it a layered term or a combo. There's a critical illness part. So I C dot illness part. That's a C and that's an I. And then there's usually a cash value part. Now, you don't have to do critical illness. You don't have to do cash value. You don't have to do term. You don't have to do permanent. But these are the 4 parts when you evaluate a policy to say, is there cash value? Is there enough? Is there permanent? Is there enough? Is it enough term? Is it enough critical illness? And so we can kind of say, hey, and then we can price out so the client knows what they're paying for. There's tax advantages to life insurance. So tax-free death benefit to the beneficiary. Tax-free living benefit. So if you got critical ill, you can get your cash value out. There's tax-deferred growth of cash value in permanent policies and income tax-free access to cash value in permanent policies through policy loans. So most people don't study taxes because they don't worry too much or think about controlling taxes. But if you're a saver, you have to be a tax saver too. And so, do we insure children? What if your children becomes critically ill or the unthinkable happens? I think you should buy critical illness on your children. The critical illness is a policy that allows recovery time in case you get a cancer, heart attack, stroke, or 25 illnesses. One of those 25 on a list. Homemakers who should get insurance. My wife is a stay-at-home wife, and if she passed away or got sick, I would need some money. Single people, hey, do you care for your parents? Do you eventually have a family or an active lifestyle? Or if you're uninsurable, we can do non-medical insurance or guaranteed. We can find you a policy. The question is, do you like the premium, right? And those who are concerned with immediate burial costs of a family, we can do final expense coverage. So there's different coverages. But if someone gets sick or a child passes away, it's nice to have some liquidity where you don't have to go to work. If you're paycheck to paycheck, you should be paycheck to paycheck and buy a policy on a kid. We do lots of insurance on the kids. We do lots of critical illness on kids where usually it's recovery money. And if you're working with as a campaign, here's 4 questions that help you sell critical illness. You ask, do you know anyone that had cancer, heart attack, or stroke? Did it affect them financially? You say, yeah. Would some extra money have helped at all? And the last one is the biggest question of all. When they got sick, was it a surprise? Was he surprised he had a heart attack? Was he surprised he had cancer? And so they're always surprised. If I got cancer, I'd be surprised too. And so would you be confident that a doctor is their best interest? So the type of CI you buy is usually 1 or 2 years income. If you're married and you want your wife to visit you, give her a year of income so she could visit you for a year or renovate the house. If you're not confident in our medical system in Canada, maybe add 50 to 100,000 to your policy so you could travel to America, travel to a different country, use their medical system. Disability insurance, the 3 main carriers in Canada are Canada Life, RBC, and Manulife. And Manulife, as of Thursday, is not going to offer their professional series disability. So it's less and less people are offering it. It typically covers 60% of your net income. Employers will pay out first before individual plans. So if you have an employer plan, you don't need an individual plan, but a lot of people buy a top-up. If you're a business owner or self-employed professional, you got a safety net and can't work for an extended period. Can your savings last? A lot of people want disability. They just don't want to pay for it. But if they understand it, I think disability is usually sold with logic and a little bit of greed. What I mean is people want an income. They don't want to be no income. They don't want to be moving on to the parents or something. And so life insurance, sometimes people buy it out of worry and fear, but disability, usually it's about understanding and a little bit of greed. Each type of life insurance has an emotion. So life insurance is sold through responsibility. Critical illness is sold through a little bit of fear. What if I get the disease? Disability through greed. Long-term care through dignity. Investments through the idea that I want to be responsible for my future when I get old. I'm afraid of moving in with my kids if I'm poor. When you travel, you leave the country, you should get a travel insurance. Health insurance through your work, dental, vision. Some of this isn't catastrophic if you don't have it, but sometimes drug coverage could be. And so if you're self-employed, you can look at pricing it out and say, hey, does this make sense for me or not? Mortgage insurance will pay off someone's home mortgage if you become seriously ill or die. It's not as clear as cut as life insurance. So bank staff typically have no training in how it works. That's my experience. They don't need a license. Premiums usually stay the same to the mortgage, but if you pay off the mortgage, you lose your coverage. I had a client 4 years ago. This client had mortgage insurance. And by the way, I was at an appointment yesterday and someone told me mortgage insurance is a scam. I don't think any insurance is a scam. I think if you have a contract and you read it and you see what it says, that's how it works. And so if you don't know how it works, you're the one who's confused, right? And so it's always a responsibility of the buyer to know. So what happened was they had a mortgage insurance. And the husband had a couple heart attacks in the last 12 months before I met with him. And so I said, okay, you bought mortgage insurance. I can't sell you a really efficient personal life insurance. And they were putting $2,000 a month against their mortgage, trying to get it paid off. They were in their 60s. And I said, if you pay off your mortgage, you also pay off your mortgage insurance. So why don't we take that $2,000 and save it outside the mortgage? That way your mortgage balance stays high. In case someone dies, it's going to be paid off anyways. And so what they did was they said, hey, that makes sense. And they actually, instead of saving the money, instead of working 2 jobs each, they each work 1 job. So they said, let's just make a little less and not race to pay our mortgage off. And it happened that the wife passed away. The life insurance on her paid out and the mortgage got paid off. And they spent 2 years not working 2 jobs. And so mortgage insurance, once it's in place, sometimes hard to replace. Now, we don't always have a bunch of great stories about mortgage insurance because many times the client doesn't understand it. Fortunately, I came in and we kind of cleaned it up. But if you're going to pay off your home really quick, then you're also paying off your mortgage insurance. And if you have a bunch of medical issues, it's hard to get this one paid out. Simplified life insurance is where we give you insurance or we charge you more because we ask you less questions. And then some questions of, hey, does my life insurance through work cover me? Your employer may provide the benefit, although you're not allowed to take it with you if you're leaving your employment. It's optional. Some do, some don't. Hey, why is it so cheap? Why is it so expensive? As you learn, there's many factors: age, health, gender. You want to review the benefits and the costs and the fees with a professional and compare apples to apples. No two policies are really apples to apples, but questions of how much do I pay? How much do I get? Who takes the risk? What are my options in the future? What are my options next year? What are the fees? Asking basic questions. And at the end, in most cases, you get what you pay for. Do you want what you pay for? You know, if you want to build up some wealth, an insurance policy is an incredible way to do it. And so we ask questions like, do you think your health will get better as you get older? If you're losing weight and you're a smoker and you quit smoking and you're going to the gym, my health may get better. Do you have a strategy that addresses your responsibilities? Do you want benefits that may help with your overall financial strategy? Will you be self-insured during retirement? Self-insurance is a funny thing. If I have $1 million, am I self-insured? So what I mean by that is, if I have $1 million, do I need no term insurance? In fact, I'd like to spend my million, and then when I die, my life insurance pays my wife another $1 million. I don't want to use, so let's say I don't have any insurance and I have $1 million, and I can only get a guaranteed rate of 3 or 4%. Well, now I can only spend $30,000 or $40,000 a year after saving $1 million, because I don't want to lose my nest egg. I want that to go to my wife or my kids. And so self-insurance is very expensive. Will you need to consider estate taxes? Do you have RSPs, rental houses? As soon as you have rental houses, there's a need for permanent insurance because you can pull that money out through refinancing, but when you sell the house and you die, those houses are deemed to be sold. And do you want to pass on wealth to the next generation? This is a funny question. I didn't ask it early in my career. Now I ask, do you want to pass on wealth to the next generation? Do you think it's noble, or do you think you corrupt your kids by giving them some money? How much do you think is reasonable? And some people want to, some people don't want to. We need to be able to listen and say, if you don't believe in passing on wealth, then we plan differently. But if I say, I personally believe if I can make my family tree their life easier, I think it's my duty to do it. And I think I'm in a position where I bumped into the right people at the right time in my life where I can change my family's future. And I don't think I want to increase my family's consumption, but maybe the productivity, where if my son wants to work in construction like I started off, maybe I can help finance a Bobcat and a dump truck, and we could get him owning a business. Instead of just pushing a shovel and owning a shovel and a wheelbarrow, we could own a dump truck and a Bobcat. And so finance helps, speed up someone's income. And someone asked a question, how do we know what the guaranteed rate for whole life? The guaranteed rate for whole life is the same for every company. It is 0. It'll never be below 0. The dividend rate is displayed on their website. That's what they do is they say, we're going to tell you next year what this year, or we'll tell you this year what next year's rate is. So next year it's 6.2 or 5.9 or whatever it is. And Equitable is easy to find. You just go to marketing material and find it. And it's someone asked here what the guaranteed rate is. The guarantee is you never lose money. So when you run an illustration, it'll always show guaranteed rate and assumed rate. The guaranteed rate is always your current death benefit, your current cash value, and then it just runs the same. Every time the client gets a statement, that guaranteed rate goes up with the assumed rate, and then just shows, hey, it's $500,000, it's $500,000 forever. I hope that answers your question, Rand. But some of the questions of, what's the best for me? What does the market want? That's one of those questions. Well, the market wants cheap policies. The market wants flexible policies. The market wants policies that last my whole life. The policy wants, and so most death benefit is sold term, but about 70% of Canadian policies are whole life. And, the rest are universal life and term, a combo of those. But you got to know, hey, how do these work? Term, if you have limited income, but you want to protect your family, buy term. If you want a policy for your whole life, you want a guaranteed rate, you want maybe take a fixed income portion of your investments and say, don't buy bonds, buy this. or universal life, you have a policy for your life, plus you have some flexibility. All of them have a chance to be overfunded. Term, you can't add more money to the term, but you could still save money somewhere else. That's why people say buy term and invest the difference between whole life and universal life. Nowadays, there's not a lot of difference because it's very hard to replace a modern day whole life with term. They're just so rock solid. It's also a universal life after 10 years, there's no fees. So sometimes they can say, hey, if I start over, I reset my ACV and there's no tax for the next 10 years. And so you can do some ACV resetting in universal life. But I think it's important to work with someone licensed. I think it's that they're professional and they have multiple well-known insurance products. And I think that the day of an insurance salesman trying to meet their quota is over. Many times we ask questions like, what do you like better? Do you like this or this and this? And everyone has a preference, but we want to utilize a holistic approach that considers their entire situation. I don't think all their money should be in insurance. I don't think all the money should be in investments. I don't think all the money should be paying off their home. I think we should do, hey, if you wanted 3 basic principles for basic financial success, pay off your home, fill your TFSA, and pay off a permanent policy. Those are 3 basic things. Pay off a policy, fill up your TFSA and keep filling it up, and pay off your home, and don't mortgage it. Those are 3 basic principles that put you probably in the top 10 or 5% of the entire world. And so, thank you. This person, Ms. Mai, says, my husband is now properly protected for our family. I heard about getting protection through another company, but wasn't educated on it. So I didn't think much about it. After my husband explained it to me and actually educated me about proper protection, I now see how important it is. I'm a proud spouse and a member of the WSB community. I love you all. And one of the greatest miracles, you can change your life if you change the way you think. And so I want to be part of the 30 million that's educated, because the evidence of that is I'm 30 million of healthy, financially healthy people. I want you to join the campaign. We're proud that you could work with us. We could partner with you, and you could bring someone to the next workshop, and you could get them a copy of our book. You can increase their cash flow, help them get proper protection, understand how to save and invest, long-term goals, and you work with a financial professional to help you improve your strategy. And my name is Daniel Fehr-Krahn, and I want to thank you for coming out.